Welcome back, everyone, to Wook Capital Management's 30th edition of our weekly Wook and Review broadcast. I'm Managing Director Rod Alsman. We're going to be walking through some prepared material today. Just want to read a disclaimer quickly, and we'll get the prepared content started. Just want everyone to be aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, so welcome back, everyone. Got myself sharing my screen. If you're in the Wook Discord server, you can follow the screen. Otherwise, I'll do my best to call the things out that I'm looking at. So we've got a few housekeeping items to discuss, and then we'll get into the prepared content. My intention is to walk through each item, kind of open it up to discussion on each item, and then we'll see if people want to discuss anything else by the time we get through the prepared content. So we basically just got through the peak of earnings season this week. Yesterday was the busiest day of the entire earnings season. This week was the busiest week of the earnings season. Overall, there's been a higher preponderance of earnings beats than is typical. Now, that doesn't tell us much about the absolute level of earnings. It just tells us about the performance relative to, in some cases, muted expectations. So we've got that going on. A lot of the Megacap tech stocks reported this week and broadly saw pretty positive reactions. We'll get into some of that in a minute. First quarter US GDP came in this week as well. It was only positive 1.1% as opposed to the 2% that had been forecasted. And the US consumer continues to carry the bulk of that growth. So it was a 3.7% growth in consumer spending in the quarter, which helped offset weakness elsewhere in the economy. The Wall Street Journal's consensus for the economic outlook for balance of year does show that the consensus, which is of course apt to be wrong, is I have it on my other screen here. Let me just bring it over here. Yep. So you can see the next three quarters, 2Q23 through 4Q23, are really all expected to be pretty close to flat. The forecast doesn't officially call for a recession from the Wall Street Journal survey, but will show, 2Q, for example, showing a 10 basis point increase year over year. Same with 4Q and negative in 3Q. So we'll see as the next few months come along with the debt ceiling, which we're going to talk about too. And we've talked about the student loan repayments kicking back on. I think there's some risks to the downside there. But for now, the US is not in what we would think of as a recession, but it certainly is reflective of what the Federal Reserve wanted to see, which is growth below trend, the long-term trend being kind of that 1.7, 1.8% growth rate that the Fed believes would be kind of in line with long-term population and productivity growth. So we're below trend, which is good. It's expected to show growth slow even further into the second quarter, but for now, the consensus, at least out of the Wall Street Journal survey, is not to see a recession in the back half of this year. We met on Tuesday night. We had our 6th edition of our book club, which was a lot of fun. We had a good discussion. Ted, I see you in the audience. Appreciated you chiming in and being part of that discussion with us around Michael Lewis's The Big Short, which for many, I know for myself, I'd never read the book until this past couple of weeks. I'd only seen the movie and I saw it one time. So reading the book gave a lot more context and some really interesting backstory on some of the protagonists that many of us, I'm sure, enjoyed seeing portrayed by Steve Carell and I keep forgetting the other guy's name, the guy who played Burry. But it was a good discussion. That replay is available, Joe, I think on our YouTube channel. If not, the audio only, which it is audio only, but the Twitter audio is available on the @Wook Capital handle if you'd like to catch that replay. Next month, we're going to be covering One Up on Wall Street by Peter Lynch, and we've got the Balance of the Year book list available. You can see it on my screen if you're following along. Otherwise, we've shared it several times on the handle, and we'd appreciate, of course, if you're interested in participating. We'll hold those discussions on the last Tuesday of every month at 8 p.m. Eastern. So the next one will be, I think it's May 30th. It's the day after Memorial Day. So Memorial Day is the Monday. Tentatively holding it on Tuesday. I noticed it was going to be the day after a holiday when I was looking at the calendar the other day. If we get feedback from people that they'd like us to shift it, I'm open to shifting it back a week potentially. But for now, I'm going to keep it scheduled as that Tuesday night. So, what else? We've got some watch list company updates before we go into some of the prepared material. Pinterest reported on our watch list. We had several companies report earnings this week. We, of course, also had the Bed Bath & Beyond bankruptcy filing this weekend, which we'll spend a couple minutes entertaining. I keep saying, hopefully for the last time, that we'll be talking about that company. And yeah, hopefully this really is just about the last time. There could be one more. We'll see. So we had that news. We had Pinterest earnings, Meta earnings from our watch list. We'll talk about those. We had Lyft also reported some incremental layoffs today. So talk about any of those. If people want to talk about any of the companies on the watch list or any other companies, they're welcome to. But before we get to that, let's go through some different items that I had prepared in the newsletter. If you received that, it's in your inbox. Joe sent it out. Came out this morning. If you don't receive that, Joe put a nice thread together that's also pinned here. So you're welcome to see some of the links there. But a few things I wanted to talk about. We're clearly seeing some interesting changes in the short-term treasury bill market because of the debt ceiling. So recall that the US government, we talked about this once or a few weeks back, and I'd said we try to hold off talking too much about it until it becomes relevant. I think it's a little relevant. It's going to get more relevant and probably more news coverage in the next few months as we either see a US government default or we see our politicians act like grown-ups. I don't have high hopes for the latter, but I do have hopes that they see the cost of a default as something they're unwilling to incur. But right now, what we're seeing, what you can see in the Treasury bill market is, and if you see my screen, I lifted this from John Author's Points of Return earlier this week. And if you have your own Bloomberg or if you're looking at Treasury spreads somewhere, you can see this yourself. But the 3-month Treasury bill is now yielding more than 150 basis points over the 1-month Treasury bill. And why is that happening? Because the 1-month Treasury bill, sometime in May, late May, let's call it 4-week bill, is maturing before the expectation that the government may default on its debt. So a 3-month bill, the market is pricing in a possibility that that payment will not be made on time. Now, I think people would generally agree that those payments will get made, even if there is a default for a period of time. But the risk of those payments being delayed is causing the market to be willing to pay more. So they'll pay more for the bond, therefore the yield is less on the 1 month versus the 3 months. So if you're a risk taker, you could go out there and buy the 3-month bills, perhaps. But the issue is that you've got a few reports that have come in the last few weeks from Goldman Sachs as kind of tax season kind of hit. You had lower tax receipts than had been anticipated. So that pulled forward the period at which the government runs out of money because it took in less from tax season this year. So I've seen estimates from Goldman. I saw, I think most recently that it was looking less like June and more like July. So they had pulled it all the way up to June in a note a week and a half ago. So I think with some of the newer data, it's alleviated that a little bit, but nonetheless, the House of Representatives passed the bill, which is dead on arrival in the Senate. The Republican-controlled House, of course, passed a bill that the Democrat-controlled Senate appears unlikely to entertain. And we'll see what the resolution, is. We've still got a few months, I think, of this before they have to resolve it or default. It's April 28th. We're having this discussion. So it does seem like within the next quarter, within the next 3 months, there really needs to be a resolution, barring some material uptick in income tax that the government takes in, or some other externality. I thought Lynn Alden, who I think she's a very excellent writer, even though I'm not a Bitcoin fan like she is. I still respect her writing. She had a great newsletter out this week, which I would encourage you to skim, with some backstory on what's happened in the past in these situations and where we stand today. So I'm going to pause. Ted, you're up as a speaker. And then anyone else in the audience, if you wanted to chime in and talk about kind of the debt ceiling crisis, if you will, welcome your input or comments, pushback, etc. before I proceed to the next topic.
I agree with most of what you said. The only thing that I would add, there was a Bloomberg article earlier today that I saw talking about the cost of CDSs, right, to basically ensure
Yep.
against default for treasuries is spiking, which yeah,
I'm looking at that article now. The headline is Bet's offering a 2,400%
yep,
payout on U.S. default. Lure growing
that's
crowd. Is
it,
that it,
yeah.
Ted?
Which I
All
found
right.
interesting because from like a payoff perspective, like I'm not exactly sure how that would work. Going back to the uh, Big Short, right? It sounded like, if you're buying CDSs, right, you get paid out whatever the difference is between par um, and what you recover. So to what you were saying, right? If it's just a delay and you get made whole, what is the value of that CDS ultimately, right? It would imply zero, unless the government like
Yeah.
literally defaults and they don't pay, you know, you back, which seems like a very low likely event.
I have the chart up from that article, and it's really incredible when you look back to the financial crisis. The cost of insuring against the U.S. default had never breached 100 basis points. It never breached 75 basis points, even in the worst of the GFC, and also kind of post GFC in 2011, as well as 2013. So it's pretty incredible to see that the cost of that insurance is now more than double the highest level it ever saw during any of those prior crises. Which your point is a good one, and I don't know the answer to that. If it's just a delayed payment, right? Are you going to be made whole for your CDS? So the story does note, given the idiosyncrasies of the settlement process, there's no guarantee the CDS will actually pay out, even if America does briefly miss a debt payment. So it's probably one of those things that, unless you are, again, going back to like the mini crisis that I've made a point on, unless you really know this stuff well, you should probably steer clear of it. You're probably going to get burned if you're just a retail investor who's trying to chase something here. But your point is a good one, that right, if a mere delay were to lead to the CDS being paid in full, then that's a pretty amazing asymmetric payoff. But I think that's where it's maybe less clear. But this will not be the end of it. I'm sure that we will continue to see more of this in news headlines and financial headlines, and we'll see what, if any, impact it has, on markets broadly. The hope, I think, of every American and probably every citizen of the world, for the most part, is that there will be a resolution, and we don't see this unnecessary test of the stability of the financial system. But if anyone has any more thoughts or input, thanks again, Ted, for pointing out that article. I hadn't caught it yet today, so that's a good one. We can go back to that, but otherwise, let me continue then. Okay, as I said, Bed Bath Beyond, we finally got the bankruptcy filing this past weekend, which it's still not 100% resolved, right? So they have voluntarily entered Chapter 11 bankruptcy, which they are doing two tracks right now. So the current plan, barring a buyer appearing in this bankruptcy process for either all or some of the assets, the company is winding down operations. They're liquidating. I know that it was a few days ago that the coupons were no longer usable, which for the long-standing Bed Bath shoppers, I'm sure that's a sad day. That was a sad moment. I think it was the 26th. The coupons no longer became usable there. If you have any Bed Bath Beyond gift cards, BBBY gift cards, you're going to want to use those up imminently before they're either A, out of stock, or B, your gift cards, you become an unsecured creditor, right? And it is unlikely that unsecured creditors will see any recovery, given what the bonds are trading at. The unsecured paper is still trading, I think, at 3-4 cents on the dollar. There's certainly some people, I'm sure, that are perhaps sophisticated investors that are buying those bonds and may, push for the unsecured creditors as part of that committee process in bankruptcy. If they get a sale of BBBY in the bankruptcy, perhaps they get enough cash from that sale that secured creditors are fully satisfied and there's something left over for unsecured creditors, right? We had this discussion. But the sad reality, of course, for anyone who's holding the common stock is that it will be delisted on May 3rd, and it is it's been worthless, I think, for a long time, but it's pretty officially worthless now. So they are in bankruptcy. They're going to try to sell off the assets. Earlier in the year, there was I think a substantiated rumor that Sycamore was interested in BBBY, and now that the company is in the bankruptcy process, I think that makes it more attractive for if the buyer that was interested a few months ago is still interested for the right price. So that it'll be interesting to see whether BBBY is sold in bankruptcy. I kind of have it pinned in my head at maybe they get $300 or $400 million for it, which is obviously a far cry from what Ryan Cohen had posited when he first brought it up in his letter a year and change ago, when he began a successful activist campaign in the name. However, the company disclosed BBBY financials at that time for the first time, and it disclosed that the implied adjusted EBITDA of BBBY was, I think it was somewhere around like $50 to $70 million. So depending on what kind of multiple you put on that, and then the question is, they never disclosed any granularity behind like where that adjusted EBITDA was coming from. So I think the truth of the matter is that the BBBY brand has value. It's one of the last man standing, so to speak, in that specialty retail space, right? Babies R Us, gone. I feel like there's another baby store that went out of business, but we'll see. So if no one buys anything, though, everything is going to be liquidated. All the inventory, the leases, of course, they've gotten out of in bankruptcy. The stores will all be closed, and as much cash as they're able to raise in this bankruptcy liquidation will go to the secured creditors, with anything left over going to the unsecured creditors. So that's about that for Bed Bath, and now Beyond the Pale. If anyone's interested in chiming in on Bed Bath, BBBY, the bankruptcy, please feel free to come up request to be a speaker. Otherwise, I'm gonna keep on rolling through the prepared content. All right, so next item was just showing some data. I think the story actually, we had a little bit of a communication issue on our side with what we included in this week's newsletter, but this, I think it was from last week, it was showing the inflows, the quarterly equity and ETF purchases of individual investors, so made outside of 401ks and other retirement accounts. And it was from Vanda Research, who we've talked about in the past. Basically, their takeaway, and the graphic clearly show a massive uptick in equity and ETF purchases by retail investors over the COVID era, and that in the first quarter of 23 even, individuals bought a net of 77.7 billion in equities and ETFs on U.S. exchanges, which trails only the first quarter of 21, which was of course meme mania, and 2022 when they bought about 80 billion. So retail is still buying, and it's still at levels that are multiples higher than pre-COVID. And I think it just gets back to the essence of what happens when that normalizes, or is this the new normal? And I'm inclined to think it's not a new normal, but you know, broadly speaking, I see reporting that the trend followers are pretty darn close to max long, while there's a lot of reporting about hedge funds being short, futures and the like. Actual short interest in the major market indices are still near all time. They're at historical, like, multi-decade lows. Even though they're off the bottom, they're still really low. So, if you think it's like a game of musical chairs where, if you're going to be a dip buyer, you better be a seller before all the other buyers disappear. I think it just kind of highlights how much activity from the retail side has buoyed many securities over the last few years. And can they continue to buy at that pace that is literally 3 or 4x the preceding half decade? I'm inclined to think not. I would appreciate any kind of thoughts on that, pushback from anyone who thinks maybe that we're in a new normal, right? The barriers to entry, of course, post the 2019 commission wars that Schwab kind of started and kicked off by going to zero commission. Maybe that lure of no commission trading has fundamentally changed how much capital flows into individual equities and ETFs. I don't know the answer to that, but I'm inclined to think that this is still above normal and a risk to kind of the outlook at large. If people are losing their jobs, you would anticipate that those inflows could quite quickly reverse, and individual investors may need to pull that cash for living expenses. I keep thinking about this debt repayment toggle that's coming in a few months here with student loan payments. There was a good story. I'm going to go into the GMEDD Discord for a second, pull it up. I'd shared it in our general macro channel, but it was highlighting some paycheck to paycheck living statistics that were out from Lending Club and payments.com. And year over year in March 23 versus 22, the percent of Gen Z that is reporting living paycheck to paycheck or struggling financially rose from 58.3 to 65.5%. So a pretty marked increase, right? Again, we're talking about an economy where we're at pretty much max, employment or close to it, historically low levels of unemployment. And yet you see, we're talking about almost 3/4 of millennials reporting, 73.2% reporting that they're struggling financially. 65.5 is Gen Z, 64.2 Gen X. So there's just this disconnect between how people kind of are responding to some of these surveys and how resilient financial markets have been, the disconnect between maybe the real economy and the financial economy. There were some other reasons behind their living paycheck to paycheck. The primary response from all age brackets was that their paycheck only covers their basic bills. Second, for all, but the boomers, is that they must pay expenses for other family members, have significant debts to repay, high non-essential spending. Now, the high non-essential spending, which a lot more of the Gen Z respondents selected, I think that's where I would highlight that point I keep making, where I don't have great data and I've not seen any really compelling report that highlights just how much of an impact on that high non-essential spending this debt, student loan debt toggle is going to cause. But the fact that from younger to older, the mix of high non-essential spending impacting their living paycheck to paycheck, it's highest in the Gen Z, and it dissipates all the way down to the boomers and seniors who they have very little high non-essential spending that's causing them to live paycheck to paycheck. But yeah, I think that's a risk for discretionary spending over the back half of the year, and looking forward when you think about those student loan bills. But yeah, so some thoughts about the kind of risks, I guess, to both financial markets and real economy. I'd love to hear anybody's thoughts on where maybe that thinking is off base, or any other data points that they'd love to share. Okay, well, I'll keep going then through my prepared content. There was a really good story this morning out, so I'll talk freight economy for a minute. Rachel, forget how to pronounce her last name, Premack at FreightWaves. She's an excellent writer on the kind of freight side of the economy, and she has some excellent statistics that go in line with something I've pointed out for several months now about risks to freight and the freight economy. So on my screen, I lifted, this is from her weekly Modes, which is just a supply chain newsletter that she publishes. But it highlights things that we talked about, like how low the spot freight market has gotten, how weak the spot freight market has gotten. Quote, early 23 is the softest sustained truckload market since the data series began in 2018, which this is from FreightWaves. So you're talking about an extraordinarily soft trucking market. And then it kind of combines some data points that I've shared about, and if you, again, are following along, you can see my screen, the change in authorized for-hire interstate trucking fleets. So there was a huge uptick in truckers, mom and pop folks who just went out and wanted to make money, in 2020, 2021, when the freight market was just absolutely booming. This graphic, I think, really helps tell the story. The total authorized for-hire interstate trucking fleets. So the number in March of 2020, when COVID hit, was about 285,000. And from March of 2020 through to the peak in September, you went from 285,000 to 425,000 carriers. And the numbers have begun to come down, but there are still about 43% more fleet authorizations out there today than there were at the beginning of the COVID crisis. So you have a ton of excess capacity that has to still exit the market. What does that mean? They're gonna either default on a loan, or they're gonna sell their equipment. Equipment prices are going to continue to face headwinds. So you all probably know, and I've talked about it ad nauseum, that I spent many years working at Ryder. Ryder is one of the largest used truck sellers in North America. Ryder reported earnings this week, and in their investor decks, they include a nice graphic on used truck residual values, which for them is very important. But for me, in telling this story, I think it helps. So it's page 20 of Ryder's most recent investor deck, which I pulled up my screen, and if you want to pull it up, you can. But you can see The used truck residual index that the company presents, which is a US fleet index of riders, um, used trucks, what the residual values they're realizing in the market are. You can see that for 2021, there was an absolute moon mission for used trucks and used tractors, where prices went to levels never before seen ever in any environment due to the inability of truck OEMs to produce new equipment to meet the huge uptick in demand. So you have a lot of, I think, those new fleets that entered the market that I just pointed out, the 150 odd thousand that are still in the market, they acquired equipment at extraordinarily high prices. So their operating cost level is inherently a lot higher than that of, say, a long-standing player. So there's going to be a continued rationalization of capacity in the trucking market specifically, and you can see the used prices have begun trending down over the last several quarters, though they are still completely, on the truck side, we're talking completely out of whack. Still almost 40% higher than any prior peak seen in the last 2.5 decades, which is as far as the rider index goes back. And on the tractor side, yeah, they've finally gotten below levels seen in 2014, late 2014, which was partially driven by some quirks in vehicles weren't manufactured in the GFC. Therefore, you had a supply crunch of used vehicles. You also had a very strong oil market domestically, so a lot of equipment was being bid up. But yeah, the essence of what I'm saying is from both what we've heard from JB Hunt, Knight Swift, across the spectrum, there's a limited visibility to the freight market outlook. It's the worst freight market for some truckers in history. I guess in part it depends on if you're playing in the spot market versus the contract market, but equipment prices should continue to normalize. So all this is good in the context of freight inputs reducing the prices of different goods that end consumers buy. So this is deflationary or disinflationary. It's good, but for the actual companies operating in this portion of the economy, you're going to see a lot more pain before you get to the bottom. And even though the market, the spot market itself, Avery Weiss at FTR Research, who I have followed for many years, believes that spot rates are nearing the bottom and contract rates will hit the bottom by the fourth quarter. He says the recovery from this will be slow and steady. And that likely means a continuation of the great purge of the smaller trucking companies that have flooded the market. So it's funny, right? I've been talking about this for a while. This week just seems like the transport market at least woke up to reality once companies began reporting. Old Dominion Freight Line, for example, a best-in-class, less-than-truckload company, had one of its worst days in years this week after reporting earnings, closing down, I think it was like 10%. So there's probably more pain to come for the LTLs, the TLs, less than truckload, freight forwarders, brokerages, folks across kind of the logistics, or rather the transport side, less so the logistics side of the economy. But it doesn't look like it's going to get better overnight for them. So this is typically transports are a good leader of the cycle. With all the noise going on now, I don't know if that will hold up as it has historically. I think the Dow Transport Index. The theory is that index is often a good leader as that goes up or that goes down. The broader indices typically follow. But yeah, that's down about 3% over the last 5 days, even after recovering somewhat today and yesterday. So I'll pause there. I don't know if anyone wants to chime in with maybe some other companies they've seen, but I didn't touch on diesel per se. But yeah, the clearly demand for heavy industry and freight is not growing abundantly right now, to say the least. Okay, but that's really about all the prepared content I had. It's 4:38, so I'm happy to, if anyone wants to go back to any of the topics covered or share any thoughts beyond that. Let's see where the conversation goes. Jiro, Ted, you guys have any thoughts you want to share? And anyone in the audience, if you want to come up as a speaker and chime in, please don't hesitate to put your hand up.
Yeah, hi Rod. Yeah, with respect to transportation and beginning of the cycle. So, although I mentioned, I think 2 days ago, right, that the banks are kind of worrying me a little bit at least. I also see a scenario where a new cycle might be starting, right? Although it sounds ridiculous, right? Because looking at PMI numbers, it's not only that PMIs have been picking up for 3 months already, right? I mean, the
Which
purchase
PMIs?
from the US, Europe, China, all of them actually.
The S&P?
S&P, yeah,
Okay,
not the
because the
ISM.
ISM
The
has not been.
Yeah, but I still prefer the PMI because the PMI applies globally, right? And it's the same methodology. I believe the ISM has a much longer history. Okay, that's correct. But I think it's only applied in the US, if I'm not mistaken. So I like the PMI because it compares like for like the different countries and regions. Um,
Sure,
and
sure. I guess my point though is that at least the US, the manufacturing PMI that comes out of the Institute of Supply Management has showed 5 continued months of contraction, um, and it's a continuation of a downward trend that's been in place for almost a year now. So I I I, I think I agree with what you're saying because I've seen the S&P Global PMIs look better, but um, I don't know. Maybe that just gets back to the point that there's so many cross currents and there's so much noise depending on like what specific thing you're looking at that maybe that's causing some of the disconnect.
yeah, but within PMI, what I found interesting was that the new orders part, right? I mean, if we look at Michael Control's Hope cycle, it's called, right? It's very famous, like because he's saying that every cycle starts with housing, then with orders, and then with P stands for a decrease in profits, right? And the is the decrease in employment, right? So if the PMI, the S&P PMI is correct, then actually the O is starting to pick up again, right? And so yeah, so I'm just saying that I see a scenario where
Hmm.
also GDP looked actually not bad at all. I mean, initially I was so surprised how the market reacted because like a decrease to 1.1%, whereas the forecast a couple of weeks ago was at 2.5%, right? Um, but it was because it was an adjustment of the inventory component of GDP growth. And what was very positive is the consumption part, because consumption makes up 70% of the US economy, and the consumption part picked up 3.7%. So that's another bullish case. And I'm not saying, Rod, that I'm super bullish or anything. I'm just saying that I would not be surprised, okay, if we are in the middle of a new mini cycle at least. Um, and and I can definitely see a scenario where there is no no recession in 2024, and all the people who are super long bonds, especially the long end, I don't know, they might be way too early, like they were way too early last year.
Yeah, I'm looking at the PMI, the S&P US flash. So I'm going to read off new orders at US firms increased at the sharpest rate for 11 months in April as new client wins, improved customer confidence, and successful marketing strategies drove the uptick, which just is incredible contrast with the new orders index in the ISM manufacturing PMI, where instead their view, and granted, this is the March report, we'll get on Monday the April report and see if that market uptick that S&P Global noted, but the ISM's new orders index, which I have on my screen, contracted for the seventh consecutive month in March, registering 44.3%, which is below kind of the expansion contraction line, and is more indicative of recessionary risk, given that new orders has now been contracting for 7 months now. So it just I agree with your notion that no one knows, and it's entirely possible that we just skip the the down cycle part, and somehow we magically appear in this upcycle because of all the fiscal spend and support. But yeah, it's just a big spread between these different agencies, and I only say that I trust the manufacturing, the ISM report more because I know Tim Fiore, and I know how. I mean, it's an older one. I mean, S&P Global's PMI is, I guess, fine, but it just is surprising to me that you see such divergence between the two's viewpoints and the data that their survey respondents are providing to them.
Yeah, it's definitely odd. I agree with you on that. The only thing that I might like to add, because as you trust the ISM more, I just trust, at least for Europe, I trust the PMI methodology, because it is in line with all the sentiment surveys that you have, for instance, in the German economy. So the PMI is it shows at least the same direction as all the other surveys that are done in Europe. That's why, at least for Europe, I'm fairly confident that it's a relatively solid, a relatively solid methodology.
That makes sense. I mean, Europe clearly has survived winter in a much better state than a lot of people had forecasted. So it's nice to see Europe looking healthier. Your point about faster growth in new orders, I'm looking at the European report now. That's good news, and it definitely lends credence to the view you pointed out, that could we be at the beginning of an upcycle in the real economy. And I think it gets back to the notion I keep saying, which, not to beat a dead horse, is you have so many, like each sector is going to be very different, one by one, and the outlooks, across geographies, across sectors, are going to vary meaningfully, and it's going to be just this very I think that the broader kind of economic data is going to be choppier, because you've got a freight recession going on, right? But you've still got not enough housing, and housing prices still being pretty strong because people are unwilling to sell their homes, which they're not forced to sell their homes because they still have their jobs. So yeah, it's we'll see at the beginning of next week. We're going to get the April data from ISM, and we'll see maybe if that is in line with what the S&P data show, that April is some recovery in the manufacturing side. We're also going to get, of course, next week, the Fed making a decision, which I know I had said for the last couple of weeks that I thought that they should hold pat. I thought that they might. It seems pretty clear, though, after seeing some of the data this week, the employment cost index, the PCE being, all that stuff being a little bit hotter, I think, than they would like to have seen, even though there are clearly signs of the slowdown broadly. The market's pricing, I think it was 85% chance of the 25 bips next week. So it does look, it's at 79% as of now. So it looks like it's pretty set, 4 out of 5 chance that we'll get this, and then it seems likely that it's over. But even more than that, I'm curious to see the First Republic. We got the board, the Federal Reserve report this morning about the failure of Silicon Valley Bank and what are the implications. So that's interesting. Unless something atrocious were to happen with First Republic, in the next couple of days, or in the banking sector in the next couple of days, it does seem unlikely to me at this point that they would just pause this meeting. But yeah, the report, the 4 key takeaways of the report from what is his name? Michael Barr, was that the SVB's board and management failed to manage their risks, which shouldn't be a surprise to anyone. Supervisors did not fully appreciate the extent of vulnerabilities as SVB grew in size and complexity. Okay. when supervisors did identify vulnerabilities, they did not take sufficient steps to ensure the bank fixed those problems. And then lastly, it calls out how kind of some Trump era regulations, deregulatory actions helped to enable this to happen. So there's not going to be any overnight changes to regulations, but they do make some recommendations in there. Obviously, there's some political pushback, but we'll see, if they're going to revamp these rules for these banks that are, not systemically important, but you know, they have a 50, 100, whatever billion that they're clearly big enough that if they were allowed to simply fail outright and they didn't have the appropriate oversight, could cause a systemic risk to the economy, as regulators had to pronounce a month and a half ago. So I'll pause there, Monad. I saw you came up as speaker. Love to hear your thoughts on what we've been talking about.
Yeah, on the PMI, right? I mean, it's been going down. The ISM, PMI has been going down, like I said, for 7 months, and we've had in those 7 months periods where we had surprisingly high GDP, and we've had surprisingly high other data that doesn't jive with the PMI numbers. So I think there's still there's still a reluctance for many industries to believe what they are seeing, and they're downplaying and getting short on inventory. My how do I put this? I'm trying to find the best way to say this. I think there is still a significant disbelief that things are as good as they are, and that pervades in the manufacturing sector, and I think that's too bad. So it's got to break sometime. You looked at it's the same thing when you see durable goods orders. It comes down 1 month and then it jumps up the next month. Its price is really high the next month. It fails miserably the fourth month. There just isn't. I guess the ability of purchasing managers, the ability of industrials to actually forecast demand and their supplies is really horribly strained, and I'm not seeing this in many.
That point right there is really something I've read through from a lot of these earnings reports this quarter, is that companies that typically have decent visibility into demand and the restocking needs across their supply chain are broadly, everyone seems to be more uncertain than I've seen in normal times.
Yeah, and it's not that they're not getting the demand at the end of it, right? They are rushing to make the numbers. They're rushing to ship off, the last squeeze of orders to make their cuts in the quarter. But they're not. It just seems to me that they're just not prepared for it at the beginning of the quarter when they should be. Rather, it's a rush to catch up at the end of the quarter. So, defense, I'll go back to this because I know this sector well now. Almost every company has got orders, and they produce just to the orders. They are not looking forward. They're not looking ahead and building capacity. They want to hold it back. So today you saw, for example, and this is just one of maybe a dozen examples in the last 5 months, is the guided munition orders were given to Lockheed not for 1 year but for multiple years, so they can start cranking it out. And it's not just defense. This kind of stuff starting to hit a lot of places, like Raytheon in their commercial engines. Is doing actually far better in terms of orders, but they're not expanding capacity, and they're always ending up, a dozen or 2 dozen engines short. and Airbus misses their A320 deliveries because Raytheon cannot deliver enough. This is across the board. Something's got to give. I just don't know what will change it. Either that the demand finally breaks down and these companies' worst fear comes true, or they get read the riot act and they actually increase capabilities and capacities to deliver what orders they have.
It's definitely tough if you're trying to plan and you have messaging from the Federal Reserve. Effectively, we're trying to induce a slowdown, and then maybe you see these green shoots of demand from your customers. And that's kind of some of the commentary I remember hearing from last month's ISM report, that companies, manufacturing side of the economy at least, are ready broadly to meet demand, but they're concerned they don't want to ramp up and then get hit in the face by a recession and then have to rapidly lay folks off. So I don't know what the answer is at this point to solve that quandary we seem to find ourselves in.
Well, the risk with that is it's the problem with that is the you're going to find other countries starting to fill in and take that risk and get that business and lock companies here out of it. So it's a balance. I don't know where that line is, but they're going to have to soon figure this out. I'm just thinking, like for example, Safran can supply those engines, Necma can supply those engines, Rolls-Royce can supply the larger engines versus GE. It's the same case with a lot of other industries that we are not. There's rarely an industry, except maybe parts of defense, where we have complete control over the entire demand. We do have other suppliers, whether it's South Korea or Japan. They're going to just step up. This is again, you're right. Maybe this is one case of Feds talking down the economy actually working, if you think about it, right?
Yeah, they're they're getting what they want to an extent. And your point about defense, like defense clearly is its own space, and I think has its own secular tailwinds that maybe the broader manufacturing space isn't going to realize. One random tidbit I found interesting was I was looking at the transcript from Ryder from this week, and I noticed that they discussed Mexican nearshoring for there were several paragraphs of the CEO's prepared remarks talking about nearshoring in Mexico and the heightened amounts of demand that they're seeing and interest that they're seeing from their supply chain customers there. So, I think that trend continues, but people, what is going to get built stateside? It seems like the stuff that's getting built stateside is the stuff where we're seeing huge federal government incentives, like for Inflation Reduction Act and CHIPS Act, and then going back to last week where we saw Volkswagen decide that it's going to go build in Canada because the Canadian government decided to match the U.S. government's incentives. Is it a zero-sum game now where countries are simply going to companies are going to countries and say, well, country A will give me X. You need to give me X plus 1 or X plus whatever for me to locate my manufacturing facility here. And it's definitely not. I don't know. That feels very zero sum to me, I guess is what I'm trying to say.
Yeah, Tesla has been doing that for years. I mean, to Jiro's point, right? So for all the people calling for recession, this is exactly the problem. This is the risk of this call is almost everybody is certain it's coming. Almost everybody is wrong on the timing, and almost nobody wants to change the call, but rather just push it out. So, and the Fed is muddying this entire thing and influencing the whole, notion that the only way to bring the prices down is to slow down economic activity, and by doing that, you go into this controlled recession that they're going to somehow get us out of. So, you know, maybe, but if it comes true, it's not going to be controlled anymore, and because at least now we have this unknown of maybe it's happening later, maybe it won't come. But when it comes, then it's going to be a culmination of your worst fears, and every reason that people have had to hedge on orders and then backing off, towards the quarter end and trying to throw everything they have into it, all that will break down. So I don't know. I mean, I think I'm trying to understand at best how we're not going to be lucky enough to get away with a light recession if it does indeed come, unless there is a policy change and Fed starts talking the other side of their mouth.
It'll be interesting to see how quickly the tone changes if the labor market starts deteriorating rapidly. Jiro, please go ahead.
Thanks.
And actually, Jiro, just real quick before you go, there was somebody had actually made a comment 20 minutes ago. I missed it earlier. He had a question. He said, "Do you guys think Ryan Cohen will do a hostile takeover of Bed Bath & Beyond?" So the company is in Chapter 11 bankruptcy proceedings. I doubt. The way I would put it is whether something happens where if he were interested in acquiring Bye Baby or not, if he did something, it really has no impact for the common equity at this point. The common equity at this point is going to be worthless either way. So I don't believe he's going to buy Bye Baby out of bankruptcy from them. But even if he did, it wouldn't do any good for common equity, as I understand it. Sorry to cut you off, Jiro. Ted, did you want to reply on that note?
No, I just wanted to comment on something that Monative was talking about. So yeah, I can go after Jiro. It's fine.
Yeah, thank you. Jiro, please go ahead. Sorry about that.
Okay, cool. Thanks, Ted and Rod. I just wanted to. I just shared in the nest. Joey had two interesting charts about GDP. Yeah. So the second tweet in the nest where he shows us a nominal GDP. I mean, I know, of course, we have to subtract inflation, so it's a fair point, right? But still, nominal still matters. Number one, right? And it's huge. It's still incredible growth, actually. If we look at the first chart in the nest, the promise that that COVID was an outlier to the downside and to the upside, he should have maybe excluded it. But still, if you look at it closely, we are at or even slightly above trend growth, right? When you look at this, the last data point. If you look at the core of GDP, which is again, it's basically the consumption component, I believe. So I'm actually agreeing with Monative. Like, I mean, what we are hearing recession. I believe before the banking crisis, there was just talk about, because inflation is so high and the Fed will hike rates and this will crash the economy. But there was no clear catalyst because nobody was talking about what will break, right? Which is something must break, something will break. Since SVB, we at least have the narrative the banks will do it, right? It will be the banking sector. They will tighten lending, and this will crush GDP growth. At least,
in that vein, though, I would say, like, I get the impulse you guys are noting that with inventory drawdowns and with resilience in the consumer, could we just chug through, avoid any recession? With the credit tightening, though, does that not like kind of put a little bit of a kibosh in that thesis?
Yeah, sure. But the tightening has started already a long time ago, if I'm not mistaken. I think I saw a chart. It has already started like 8 months ago, I believe, right? In the Q1 GDP number, we also have actually the SVB saga inside, right? Wasn't it the 10th of March, if I'm not mistaken? We also have Credit Suisse inside and everything. I I totally understand that there might be much more tightening going forward, and it doesn't show up in any how do you say in any data yet, right? But this how do you say? But I'm just saying this catalyst, right? That the banks will cause it. I mean, like I said, like 2 days ago, I said yes. If there's something, it must be the banks. But I also don't see us hitting recession with that kind of GDP growth. And and this was supposed to be how do you say? Because the market was pricing rate cuts in the middle of the year, right? Because there will be a huge recession. The market already repriced a little bit at least. Um, so by pushing the recession further and further back, I'm just wondering if we might miss the bigger picture that actually we are not at the end of the cycle, but maybe, just maybe, we are at the start of a new cycle.
That's the classic no landing, scenario, right? I want to believe that, Gerald, but I think the data is all over the map. I think we really need to have some more consistent data on one side or the other. That's my worry. We seem to be skewing one way, then the other way. We're moving too fast in each way, and there isn't a defined direction, right? Just like the market, we lose 80 points one day and gain it back in two sessions, and then the third session we double over, and then we give it all back in the next three sessions. Who knows? uh, but again, right, it's not to your point, things are certainly not bad, not yet at least.
They're not, and that makes me worry when I see what I was referring to earlier about how many consumers are reporting how stressed they're finding themselves. And this is without student loan payments being turned on. This is without job losses becoming meaningful or the labor market
but
loosening
but
meaningfully.
Rod, again, let's go back to the data, right? It doesn't actually appear in the bank's balance sheets. Look at all their so today, uh, this morning there was a statement from Capital One CEO. I think they reported yesterday, if I remember correctly. But the CEO basically said that their net charge-offs and their loan loss provisions are just trending back to pre-COVID levels, and they'll probably get there by third quarter of this year. So it's not like we are defaulting at some horrible rate. We're just trending back to the longer term mean.
Yeah. Ted, did you want to chime in?
Yeah, Rod. So going back to what Monitive was talking about before about the timing of a recession, I think, in general, it's very difficult, right, to predict the timing around something like that. And if you look at the prior two or three recessions in the United States, right, going back to COVID in 2020, you had the great financial crisis in 2008, and then in the early 2000s, the dot-com bubble and the September 11th attacks. Those recessions were black swan events, right? Very difficult to predict. Um, and there was an interesting piece in Barron's last weekend talking about, kind of trying to time it, and barring some like, black swan catalyst that causes a recession, if you assume kind of a slow session today, Barron's had an article talking about the SOM rule, which is coined for a prior Fed economist. And basically, what the SOM rule says is if you look at the current unemployment rate, if it's 0.5% above the prior low, right, in the last 12 months, we are currently in the early stages of a recession. And I think the current unemployment rate is like 3.5%, 3.6%, right? Plus or minus. I think the low over the last year is 3.4%. So if you kind of go by that rule, until we get to 3.9% from a timing perspective, right, it would say we're still not in the early stages of a recession. And then the last point I would make too is I think, if you kind of look at the way that the economy has evolved after COVID, if you take into account all of the idiosyncrasies around around monetary and fiscal stimulus and the rolling supply chain outages, inflation, I think there's an argument to be made around kind of the validity or the weight around like traditional like recession measures. And my mind goes to last year when we had 2 consecutive quarters of negative GDP growth, but we didn't have a recession. So yeah, I think those were the points that I wanted to make. And I also saw something cross my computer screen about a half hour ago. Hour ago about First Republic. So supposedly sources are saying that they are going to be put imminently into FDIC.
Yeah. First Republic's down
receivership.
44% after hours.
Yeah, and I mean today was obviously a really bad day for them too. They were down 43.5%, on the day. Year to date, I think they're down like 97%. So yeah, down another 43% or so in the post market.
Yeah, before Giro chimes in, so one thing for folks listening who aren't familiar with the SOM rule, Claudia Somm is as Ted noted, a former Fed economist, and the definition is that per this rule, when the 3-month moving average of the headline unemployment, the U3 unemployment rate, the 3.5 rate, rises by 0.5 percentage points or more relative to its previous 12-month low, that signals the start of recession. So really, if we see unemployment, headline unemployment tick up to around 4%, that would be indicative based on that rule. Now, second, to build on what Ted just said about the headline, I'm looking at Reuters now saying, quote, U.S. FDIC preparing to place First Republic under receivership imminently, a person familiar with the matter said on Friday. So it looks like that's going to happen over the course of this weekend, being put into receivership. And it will be interesting to see how that percolates either over the weekend or as markets reopen on Monday. Which, yeah, I mean, FRC stock, as you were noting, it's now in after hours trading under $2. It's down, 99, I guess, % from where it was at the start of the year. And unfortunately, it looks like equity is effectively being wiped out now when receivership is going to happen from this reporting. But Giro, please, your hand up. Go ahead.
Yeah, I just wanted to answer to Ted, and I 100% agree. And I read that also, that the 0.5% rule. To that, I just wanted to say that Michael Cantrell had a very good interview with Wealthian, how do you say this, YouTube channel, and there he actually explained that all the indicators already point to recession apart from employment, but he sees initial claims upticking, right? And but by now the last print, how do you say, it was also down, right? Initial claims. So that's another point. I mean, I understand it's noisy, and I know each month might be different, plus minus something, but I also see another catalyst for a positive event, which is the resolvement of the debt ceiling, because I think everybody here in this room agrees that the US will not default, and the US will also not, because there are other theories.
I don't trust
really
the Speaker of the House to be able to get a resolution, frankly.
Wow. Okay, because I think, what I could imagine worst case would be a delay, a 1 day delay, 1 week delay maximum, right? I mean, which I'm not sure if that's legally considered as a default. But as soon as the debt ceiling is raised, that's another positive catalyst, right? Let's say it's in July.
So let me push back on that one, though. Positive catalyst for what? Because when it's raised, as I understand it, that will cause a large outflow of liquidity from the financials, kind of from the market side of things, as the TGA has to begin kind of filling back up. So a lot of the liquidity that's been poured into the market year to date begins to reverse itself, is my understanding. Am I off base there?
I'm not an expert, Rod, but I always thought if you increase the debt ceiling, then the US Treasury can issue more bonds, right? And no, you're right. Actually, it takes out liquidity, because if they issue bonds, the banks buy those bonds, then the Treasury gets the money. Yeah, you're right. It's not in the system. It's not in the banking system. The money goes to the government. Yeah, you're right, Rod.
So this drawdown.
Only if the Fed is on the sideline at that point. If the Fed starts buying, then it doesn't.
Yeah, but another catalyst that I might mention. Sorry that I'm interrupting you, Martif. How do you say it? But just a second. The second thing that I believe that will be crucial for this year is that, of course, Joe Biden will also play a little bit with fiscal stimulus. I mean, he doesn't want to lose the election, right? So I also see, in the second half of this year.
But what can he accomplish without control of the House? And the SPR's already been meaningfully drawn down, but you would think that could be a lever he could toggle. Or what are the other levers you're thinking of that he could really lean on?
But isn't the Senate is majority in Democratic hands, right?
It is.
Yeah, so I'm just thinking about. Okay, you mean okay? You also need to pass it through the House. Okay, I understand. But yeah, but I'm just. Okay. So you mean even if he wants to stimulate, like, how do you say, in a fiscal way, he would not get it through.
Republicans agree to a stimulative package, which seems, frankly,
they would not agree because it's election season. Okay, yeah. I got you. Okay, I agree with you. Yeah.
See your hand up. Go ahead, man.
Afternoon, folks. I just wanted to touch up on what Jiro was talking about a second ago. I don't think it wasn't the House still. Wait, was it the House or the Senate? Where I thought the Republicans had a slight majority, and then that's why a lot of.
And they passed the bill already.
But the other thing that I'm kind of worried. Oh, okay. Yeah, the only thing that I'm kind of worried about, the last 3 years, I think literally people lost their minds to the point where they're either voting in people, people have either gone too far left or too far right to the point where, they're okay with burning the house down, essentially. Generally, any other year, I'd be like, okay, the debt ceiling raise, it's a sure thing, more or less.
Right.
But this is one of the few years where I'm like, okay, some of the constituents, some of the congressmen and the politicians are a little bit more on the crazier side, where they will say, hey, we don't believe in this system. I'm listening to people that talk about how the Fed shouldn't exist, X, Y, and Z, burn it all down, the Great Restart, and all the other stuff, where they'll vote to not raise the debt ceiling because, like, I think there was like a lot of weird, slogans essentially, like that's been going around the internet, and like big government, or like kind of like a shadow government, to the point where they're like, yeah, like for instance, Marjorie Taylor Greene, or what's her name with the glasses? Oh, Lauren Boebert. Like I don't think a lot of them like have any understanding of like how the economic system actually works, maybe. But that's my 2 cents, and that's like a risk. And by technicality,
and the market sees the risk based on our conversation earlier about the spread between the 3-month and 1 month. The market is pricing in a far greater risk than it ever has before. So the market is also perceiving it as a serious, albeit not. It's not pricing it in as a likelihood. It's just pricing that tail outcome in more than it has in the past. So, and the market agrees with some of your sentiments about this political landscape being more conducive for there to be a default.
Yeah, and then I also do want to point out, technically technically not defaulted. We've already passed debt ceiling. What was it, like Yellen's just doing a lot of financial magic to keep it afloat until like June, wasn't it?
Right. So that's not new. That's happened many times before. The extraordinary measures that you're referring to.
Gotcha. And then the question is, if the debt ceiling were to be defaulted, even for like, until they figure out why they should like vote on it, where do you think the market is gonna go? Like, I'm kind of like seeing like we might get downgraded. We like what happened back in 2008 when we like our debt went from like AAA to like AA or something like that, or A, or
right, the downgrade. Yeah. Sorry, what's the question?
Oh, the question is, where do you see what would happen if the U.S. were to default, and what moves, just to hedge against the slight possibility that that might actually happen? What would be the move on that?
Well, going back to I don't know when you joined the conversation. We had a decent discussion about this earlier, and Ted had shared a Bloomberg story this morning. So in the story, for example, there's a quote from Boaz Weinstein at Saba Capital, and he noted, quote, "In Washington, people think it's like 30% likely to happen. And on Wall Street, people think it's like 0 to 5% that this doesn't get resolved." So if you believe that sentiment, then the risk is not currently priced in enough by Wall Street, if you believe his sentiments there. Now, is it really 30%, right? Like, people are just kind of guesstimating. And to your real question of what happens, I don't think anyone really knows, given it's never happened before, right? Could there be further my brain isn't working. Could the ratings agencies further cut U.S. credit ratings? That's a possibility. I don't think people know. No one knows what happens if treasuries are just not being repaid, given that treasuries are the foundation of the global financial system, effectively. So it's not a thing that, going back to your point about politicians not necessarily realizing the enormity of their actions and being so hyper-focused on their partisan whatever it is that they're pushing for. It's a very real threat. It seems like it's riskier than it's ever been in our nation's history, and no one wants it to happen, but I don't think anyone really knows what happens. And we talked earlier about, we don't know if the credit default swaps will pay out if there's a brief default, but that creditors are made whole in a week or in a few days. I don't think anyone knows the answer to that.
Well, I thought something similar happened like 9 years ago during Obama, where government officials were essentially furloughed for about a good month or two. Or did that?
Yeah, they just issue IOUs. It's not a default. It's certainly a delay, and the focals are horrible. It did end up with a downgrade of the U.S. Credit rating, but it's only a delay. It's not really, we're not saying that you get 98 cents on a dollar on everything the government owes you. It's not. It doesn't go there. well, if it goes there, then clearly all bets are off.
So let me add, before the folks with their hands up chime in, from that article that we were referring to, quote, a so-called determination committee under the oversight of the International Swaps and Derivatives Association would ultimately have to decide if the swaps pay out. Market watchers say a lack of historical precedent, notwithstanding a late payment on some maturing Treasury bills in 1979, would make what's already a nebulous process even murkier. So you'll have a committee decide if the payments aren't met, right? If those CDS holders are going to get their windfall profits or not. So unless you know the folks on the committee and have spoken to them and know how they intend to rule, right, you probably don't have any insight that's beyond that of the market. But I see that Common Sense Investing, you came up. Let me get to you with your hand up first, and then Jiro.
Yeah, I just wanted to come back to the yield spread discussion. I mean, I've posted about this a little bit, but if you go back to 1979, I mean, at least the spread between the 2 and the 10 years was a lot wider than it currently is. And we did, the yield curve has successfully predicted every recession since 1970, but the actual spread is pretty meaningless in terms of severity. I mean, we had an inversion in 2006 and it was very small, and then it inverted slightly again in 2007, and that led to 2008. So when you raise rates as fast as we have, you're going to have a yield curve that looks a little wonky. This is similar to 1991, which was the second worst year in bonds, and the second fastest hiking, in terms of, just the sheer speed of which they've hiked the rates. So I don't necessarily get as bearish when I look at the spreads and think like, oh my God, the world's going to end, because historically speaking, like, the amount of the spread hasn't really correlated to the severity of the depression or the recession. So that's all I had to say.
All right, appreciate the input. Jiro, go ahead, sir.
Yeah, just a quick add-on to the U.S. Treasury, how they can extend the so-called X date, right? So it's also what I heard is that they can take the pensions of the government workers, of all these poor guys. They can just take it and just use that to pay, to have a little bit more budget. But I think it's crazy, because if you were the CEO of a company, right, and you used the pension payments of your employees, right, to pay off something else, it actually sounds crazy, but it's not illegal, right? So, but I haven't heard like how many weeks they could gain by using that kind of method.
So just a time check, it's 5:26, so I'm going to let this run till 6 Eastern. And if anyone who's listening wants to chime in, whether on the debt ceiling discussion or on a different topic, please feel free to come up. Steve, nice to have you back. If you'd like to chime in, feel free.
Hey, what's going on? I don't know what we're talking. Are we talking about Bed Bath & Beyond?
We did talk about it at one point earlier, yeah.
Okay.
We were talking about debt ceiling right now.
Oh, okay. Well, did you guys want to do? Were we done with that topic? Was the BBNY, or just want to? I thought we were going to talk about it.
What?
Yeah.
I mean, we talked about it. Did you want to say something about it?
Well, I just want to. It's elaborating on like what's happening and what could be happening with this whole situation. I remember like a year ago, right? Like I was looking at the balance sheet, and then like their ABL, it's shrinking, and the cash flow is shrinking. Is that literally they're just hang like in a cliff? It's like I'm surprised it took this long for them to fail that Chapter 11. But so I think what's going to happen now, right? So you have they have to closure 300 or 360 their stores, and then along with maybe 120 BBBY locations. If somebody come in and then will come in to buy it out, and they will be able to ease down their closures. However, I think what was really interesting is how this is gonna, if people are looking at what's gonna happen if BBB they close in terms their the after effect. If looking to like if there will be market share opportunity for some breaking waters or maybe online retailers, that's something if somebody could if you're looking for opportunities, for example, like maybe Target, Walmart will be distributed evenly for those channels, for breaking water channels, and maybe I'm not sure for online channels because it's kind of mixed. Because if you're looking at an Amazon report, the furniture sale is not as encouraging. Perhaps maybe there's a company called Overstock, maybe could benefit from their channel, but that's we have to see whatever data is going forward. But what I was gonna point this into is how this gonna really roll into the commercial REITs sector. So I think it's interesting. So retail REITs is gonna have some impact on this type of event. Even though some retail REITs does not have as high as discretionary exposure as to Bed Bath and Beyond and such. But I think it's interesting because just giving a sense, we just heard the news of the FRC siege by the FDIC. I think it's interesting to look at what are some of the spillover risks. Because I was just reading Howard Marks' memo. I think last week he published a memo regarding to the risks, of commercial real estate, especially like office buildings. So because we're looking at the commercial REIT sector, engage. There's like about they're kind of the in terms of the loan is evenly distributed, in different banks, but they're not the same. So if you're looking at for example, different sectors, let's see, we're looking at U.S. banks. So we're looking at U.S. banks assets about 12 trillion ish. So if they estimating to hold about 1.8 trillion face value in the real estate commercial rates loans, so that will be representing 10% average banking assets. So the losses on the mortgage on the average loan book will kind of wipe out equivalent percentage of average banking capital. So you're leaving some bank undercapitalized. So I think this is what Marx was referring to in terms the undercapitalization risk. So I think that's interesting. Just to mention that.
In that vein, I had seen Greg Ip, who is a Wall Street Journal writer. I think he's a good writer. Had a story earlier this week talking about kind of the mix of how much of the shadow banking sector has accumulated significant outstanding debt balances compared to your formal kind of banks and commercial lenders. So private credit, leveraged institutional loans, that kind of stuff has grown massively since the last time we had these issues. So I'm not a REIT expert at all, but there's clearly issues with a lot of commercial properties that are going to be sold for a lot less than they are marked on people's books at. Some markets worse than others, obviously, but I don't have enough expertise to comment. But to your point about Bed Bath, all those leases are going to get wiped. The company goes bankrupt; those lease obligations are gone. It's not good for the owner of the property. If you have a big box retailer that you've got to fill that fill that box with. It's like who's going to fill all those BBBY stores up? Probably not good for those local markets and for those REITs.
I don't think banks are going to lose $1.2 trillion on their CRE. Those are just theoretical numbers. If you go and look at the reports, actually it's very interesting. There are more than a handful of banks that have detailed out their CRE exposure, I guess because this is becoming a big deal. So they go by percentage what is their loan to value on each of those. And from the ones that are relevant to me and the ones I follow or want to invest in, most of them are below 70% loan to value. So you have to first lose 30% of the value, and only then it even defaults to anything that the bank takes on their books. So I think we're jumping the gun again on the level of CRE exposure. The losses are likely to be much smaller than worst case scenarios.
Sick of your hand. Go ahead.
Yeah, since we're on the topic of BBBY, let me just adjust my tinfoil hat for a second. I know this was like thrown out like in the past in like the meme circles or the conspiracy circles about like Ryan Cohen like somehow being able to get. I know you guys talked about this a second ago about Ryan Cohen buying Bye Bye Baby, but is there any likelihood that like once it goes through like private equity, like you said, he could literally buy cents on the dollar essentially? Wouldn't that make more sense for Ryan Cohen to wait until Bed Bath & Beyond goes completely out of business, goes completely on sale, and get it then?
That's where we are. They filed this past week, and they're looking to shop the businesses. And if a buyer appears and they can get the right price, they'll sell either or the Bye Bye Baby business or the Bed Bath business. So as of now, though, if a buyer doesn't appear, they'll be liquidating. I do think, though, given that Sycamore was reportedly interested earlier this year, whether they or somebody else buys Bye Bye Baby, I think there's a decent chance from my observation and what I've seen reported that asset is bought out of the bankruptcy process. I don't think Mr. Cohen gives a shit, frankly. I don't think he has any involvement with the business, and he hasn't since he exited, in my opinion. But I have no unique insight there.
Is that the only reason why like that was floated around that Ryan Cohen might buy Bye Bye Baby?
I don't know why apes do what apes do.
Oh.
I mean, I don't know why gratuitous, just irrational speculation happens and it gets repeated in echo chambers. It never made any sense to me, but a lot of people decided to do that for whatever reason.
Okay. And then like I was hoping to go back to the topic about like possibility of whether or not like a recession would be is back on the table. Or I mean like or people like I think Monet said that there might be no landing, and we just keep going as business as usual. In terms of like the energy market, it seems like everyone's just making cuts. I mean, PBR just announced that they're doing production cuts also. I'm not sure whether it's because they're aligning themselves more with the OPEC side, or are they just seeing like a fall in demand, or what do you think the decision for that is in terms of that, or them or OPEC? And do you see and is that the main reason why like energy is so cheap right now?
I just want to add something. I'm not calling for no landing. I was just explaining what Jiro was saying, that we were taking off again in terms of economic activity. I don't think no landing scenario is likely. I'm just saying that that's what he's describing. That's all. Quick comment on oil. It comes down to the same thing every time. the cuts that OPEC puts out is not the production that comes out, right? They always overproduce. Even the last cut, not the one announced recently, but the one announced last year, they barely took out, I think from what I read, 30,000 net barrels or something went off the market. So they are overproducing, but they're also, barrels that come off in one place get replaced by somebody else trying to, squeeze out money, like Nigeria, Libya have stabilized now, but had bigger problems, early last year. So I think the net barrels coming off the OPEC cuts is much, much smaller than their actual cuts, and that's why the price is not able to stay up. And there's a demand issue, right? If you saw across transports, you go back to this discussion again, I'll try to see if I can find the post. I think it was E. Finley Richardson or somebody else that posted the diesel demand in both
Yep.
China and in US has fallen off dramatically. So not dramatically, has fallen off significantly. So you do have all these problems. So it's not that there is across the board demand destruction, but there's enough of demand destruction and there's very little of actual barrels being removed. So add all that explains the price action, in my opinion.
And to add to that, you need to remember that it's not a monolithic market. So within the raw crude barrels that are produced, you're going to have, and there's weakness in diesel and distillate, but there's strength in gasoline, and it gets very granular very quickly. But I would elaborate on Monadev's point that the weakness in freight that we talked about earlier. If you missed that part of the conversation, we been talking for about an hour and a half here. So that weakness in whether it's ocean freight or on highway freight, those tractors are using diesel fuel. Diesel fuel is clearly, with the big drop in, there was the article in the Wall Street Journal that I think Monadev was referring to. There was a big drop off in trucking demand for contract freight, and that kind of set a lot of the transports off this week atop the earnings that were coming out this week. So, weakening industrial activity and freight demand, that's bad for diesel. But then you've still got pretty light inventories, at least domestically, for both diesel and gasoline versus historical levels. And then on the consumer side, as we did talk about, the consumer is remaining resilient. And most consumer automobiles are still powered by gasoline. So there's some nuances, I think, in that discussion, whether we're talking about refiners or are you talking about upstream producers and where you're talking about them, that it's hard to paint the oil market with a broad brush is what I'm trying to say. And I am not an expert at all in the market, so please, if someone had any additional insights into the space they'd like to share, please do.
But cool. Thanks for that input. Like I'm also what the heck do you want to call it? Like what you said, we're in a bit of a freight recession, but once we pass out of it and consumer demand comes back up again, let's say summer, well, I don't know if it's going to be by summer or like by fall or winter, so that would probably pick up diesel prices again because of consumer demand, thereby also increasing shipping, right? Or freight shipping.
And then that's the demand discussion. And then there's also the supply discussion where Javier, I don't know how to pronounce his last name, at Bloomberg, kind of called out last week. You have a lot of incremental capacity coming online in the refining space that has been kind of caught in this world of tight capacity as well as high demand. And that's why, crack spreads for the refiners went to the moon and have remained pretty elevated, but there is a lot of incremental capacity coming online globally. And so that's kind of where, diesel and gasoline cracks for refiners are kind of taking it on the chin from both demand weakening as well as concerns about supply coming online later over the course of this year and next.
Although that also like brings like another thought in my head right now, like maybe like a bull case thesis in terms of the freight side. So recently, like majority of the layoffs that I've been seeing, I'm sure you guys got a more accurate data set on this, but a lot of the layoffs have been coming in from like the high income earners, tech jobs, that portion. But then uh, one of the things that uh, maybe I'm hoping that the U.S. government realized is if there was like a gigantic shutdown or whatnot, we don't have a lot of the industrial, a lot of our industrial capabilities were like outsourced to like outside of the U.S. and hasn't a lot of the investments that we've made the last couple of years to bring back like inshoring back jobs. Is that are we seeing any like noticeable effects on that right now that we could like factor in? That might say, hey, since a lot of the industry and manufacturing or whatever positions are now coming back, we're probably going to need more freights or shipping, thereby demand for oil goes up also. Is that a
It's
like
oversimplified, but I would add, I mentioned this earlier, and I don't think you were on the call, but I'll repeat it. Referring to nearshoring trends, I had heard Ryder talk about it a lot, actually, in its earnings call earlier this week, and they noted, for example, the number of truck border crossings has increased more than 20% per year since 2020, referring to border crossings between Mexico and the U.S. Approximately 40% of new industrial space in Mexico was attributed to nearshoring activity in 2022. Them touting their own cross-border capabilities, but yeah, I think that they're seeing, and when I worked there, they were seeing, and as I observed them from afar, they continue to see. Quote: "We continue to see increases in our sales pipeline for Ryder Mexico, with approximately 20% influenced by nearshoring. Current pipeline activity related to nearshoring is largely from the automotive and industrial verticals." So that's some color from Ryder, who is a big North American logistics and transport operator.
that actually makes a lot of sense too. And thank you for that data set because like that was one thing that I was like kind of eyeing. A lot of like Korean and Japanese companies, because of whatever trade deals that they made with the U.S. Or was it like 33% has to be? Was it 33% of the car has to be manufactured in the Americas, whether they buy the car parts like outside of the U.S. in China or Korea or whatever, then they have to ship it over to either Mexico
compliance, and then now
yeah.
with IRA, you've got the battery materials and what mix of total assembly. So it's very complicated, and the rules do potentially make it marginally more attractive, of course, to manufacture, whether in the U.S. or in Mexico or Canada, for these related industries that are covered by IRA. And it's happening, but I think it's not it's not an overnight thing, and B, it's still, I think, broadly people pursuing China plus one strategies. So whether that plus one is Vietnam, India, or Mexico, it's not an exodus out of China per se. It's looking to have redundancy in their supply chain and resilience in their supply chain, so they're not wholly dependent on China for sourcing.
Yeah, that is something that like me and my mom actually like my parents talked about because they kind of follow the Korean news a little bit more. Like a lot of Korean companies have been like trying to like double up in Vietnam, India, or whatnot, just in case China does something strange, essentially, like you said. But the other reason why I kind of want to like bring it up is because like my parents were like trying to like ask me how to figure out how to get them like Korean stocks, essentially, through like my broker or whatever. But mainly because like they're also quite very bullish on like funny enough like Hyundai, because like they're seeing a lot more of the Ioniqs on the road now. So,
and I think it was just this week that Hyundai announced another battery EV facility. Yeah, it was earlier this week, a $5 billion facility that they're going to build in Georgia, which again, there's just been a deluge of investments of these sorts since the Inflation Reduction Act is passed. So policy has consequences, and we're certainly seeing those consequences in the form of a big uptick in battery manufacturing being located in whether it's the South or Tennessee, Georgia, South Carolina seem to be getting a lot of it.
I also want to point out from what you just said right now, like a lot of Koreans are also kind of ticked off about, like, or at least my parents anyway, they're ticked off. They're kind of scared about after hearing about Samsung's earnings recently. But then I had to try to explain to them that more than likely Korea's making up for it in different other industries right now, whether it's like in defense or in automotive. Mainly because I know, like, whatchamacallit, like, people were like saying, oh, 95% down for Samsung in semiconductor sales or whatnot, and then whatchamacallit, like, unable to, like, sell in China essentially. But yeah, thanks for that info though.
All right, 10 to the top of the hour, at which point I'm going to try to wind it down. So let's hopefully not take it off on an entirely new tangent, but if there's any comments, whether from the folks who are speakers right now, and thank you very much, everybody who decided to come up and speak and share what you're thinking and your questions, we appreciate it. Or if anybody's listening in and had wanted to either expound on any of the topics, you're certainly welcome to as we get ready to wind things down. Common sense, let me bring you back up. Go ahead.
Yeah, I just have one more question. Wook Capital or Monetize, as far as timing of the recession, when do y'all think? Do y'all think later this year, 2024? Like, what are you thinking timing here?
I'll take it before Monetize does, but I've said this several times. It's pretty obvious to me that it's going to roll differently across both geographies and sectors. So California, parts of California will probably enter recession before Florida does. And they're just based on the fact that their industries that they have a higher mix of have already seen more layoffs and challenges to their commercial real estate, et cetera. So if the question is kind of like when would the U.S. writ large prospectively enter recession, I would err on beginning in the back half of this year at this point in time. But that isn't to say that you don't already have areas that are in recession or that you won't have areas that avoid a recession.
Yeah, I don't disagree. I think it's going to be vastly different between different parts of the U.S. But to add to Rob's point there, I think overall recession numbers might again surprise and not really show up, in the sense people are waiting for. Just as an example, right? Most of the non-tech, high-tech industry has been outbid in their ability to hire technical talent. They have not been able, they've been priced out of it. So all the people that are being let go now, as long as they're willing to take a job in the industrials, in other industries other than tech, there are plenty of positions available for them. So in that sense, they might end up making a lot less potentially, but I don't think the unemployment is going to break down to the level that people are expecting to have a deep recession. So my take is those might come early next year, and it's likely to be shallow in the sense we're not going to go have 7-8% unemployment. I think that's very unlikely. That's my take.
Yeah, I would agree with that. I'm in tech right now, and I mean everything's okay, at least in my sector. I'm in like healthcare IT, so fingers crossed. that everything will be good for me this year. But I appreciate that, guys.
Sure thing.
There's an article by Liz Young from SoFi. She's been talking about business cycle, and then one thing she's saying that I mean, you go look in history that when you say recession, usually if you're talking about economic recession, that's usually the last thing happens, and then also it's after effect. Like if you look in the way, like you don't really call the government didn't really officially call a recession after it already hit. So you might not really can time that specifically. I mean, there's much more thing will happen before that the official recession call.
Yeah, and so that we don't end on maybe such a negative tone too. I think the concept of a recession, it's very different when you're talking about an absolute scale of something like 08 and what ensued, and what I think Monad and I probably both agree is more likely to be a shallower, modest recession. As he noted, it's unlikely that unemployment is going to reach up into the high single or double digits. And while yes, a recession, a slowdown, a decline in rates of growth and potentially standards of living is not a great thing. It is part of the business cycle, and for there to be a modest recession, if you wipe out some of the zombie companies from the economy and you allow capital to be put to work in more productive ways, net longer term, that's probably healthier than a perpetual state of inducing fiscal stimulus every time the cycle is trending downward, and running the company's credit card bill up every single time, like to an extent. I don't want to go down that one too much right now, but I think there's nothing that I see out there that tells me there's going to be some massive just decimation of the economy, and we're going to see some huge declines in GDP. I guess it's always conceivable that an event happens that is unaccounted for. That's a black swan by definition, right? But it seems more likely to me that we just kind of start to come off of some of the juice that's been coursing through the veins of the consumer over the last couple of years, and that's okay. And I say it's okay, and of course it's uncomfortable and sad for when people do in fact lose their jobs, right? It's not a recession for me until I lose my job, then it's a recession, right? So we'll see what happens, and I think we all tend to agree it's the rate of deterioration in the labor market and whether that begins to go nonlinear, and that'll be the stuff to kind of really monitor. Is if you start to really see significant labor market deterioration, and then it's a sure thing, I think, right? As Ted noted with the SOM rule, once that kind of you get a 50 basis point bump in the headline unemployment off of the prior 12 month. Once we get that at some point in the back half of the year, I tend to think, then yeah, we're there. But will it go from 3.5% unemployment and triple to 10.5%? Probably not. It's going to double to 7%. Even then, I don't really know that I think so. The labor market's pretty strong. We have a limited supply, although good news. I saw some good reporting showing kind of while we on a cumulative basis are still missing the immigrants who didn't come to the country during the tail of the preceding administration and during kind of the COVID lockdown. It's great to see that the kind of monthly inflows of immigrants into the country are now higher than they were pre-COVID. So that's helping from a labor supply perspective. But I don't think that's the thing that pushes us into recession, because we have an excess labor supply. But there's some thoughts. Monad, I don't know if you want to add anything, or anyone else on the speaker panel want to chime in on recession thoughts and labor market thoughts before we maybe wind down.
I think it will be interesting to see what Powell is going to say at his as the next meeting press conference about the wage inflation thing. That's because the PCE data come out today. It's still pretty flat. So I mean, they have their own price stability mandate to accomplish, and then in order to achieve that 2% target, you have to keep that. You have to keep that the rate to a sustained level for at least for a longer period to bring the economy to an equilibrium. So we'll be interested to see what what was going to happen at FOMC meeting.
Yeah, you're right. The ECI data today would imply that them doing one more hike is probably still in the cards as the market's pricing, because wages are still rising. Even though they're decelerating, the rate of growth is still, I don't think, in line with what the Fed would believe is stable prices or a stable price regime. Oops. Jiro, let me add you back as a speaker. You want to add a last thought there? Go ahead. I can't hear you, Jiro, if you're speaking. I don't know if anyone else can hear him.
No, I can't hear him either. So.
Okay. Common sense.
I was just gonna say one thing. I mean, it was a great space. It's good to hear you all kind of be a little more cool-headed. I go in a lot of these spaces with macro now, and it's kind of doomy and gloomy. I think you phrased everything well, and I agree with everything. So I liked your take.
Oh yeah, if you come in my spaces, they're not going to be doom and gloomy. They're also not going to be rah. Try to keep it pretty even keeled. So thank you for that. And I'll take then, Jiro. Let you get the last word in, and then I'll wrap on that.
Cool. Okay. Yeah, I just wanted to say, because it's very interesting that you mentioned the employment cost index, because I wrote a thread, I think 2 weeks ago, about the different measures of wage growth and wage inflation. So, and what I also learned was that, first of all, it is actually okay for wages. I mean, it's fairly healthy if wages grow above headline inflation, right? Let's say if long-time headline inflation is around 2%, then it's actually fairly healthy if wages grow by 3 to 4%. Yeah. So what I just want to mention is, first of all, it's actually very positive that that ECI actually confirms that wage growth is still pretty strong, and ECI is also the most accurate measure of wage growth. But the problem is, when you get these monthly numbers of average hourly earnings that you get with non-farm payrolls, they are super noisy. They are completely useless, because what they are doing is they are just using all the people in the non-farm payroll report, and then they are just dividing the overall compensation divided by the divided by the number of NFPs, right? And the problem is that it doesn't account for the composition, right? So it is possible that in 1 month there are more workers hired, let's say in the tourism sector, right? And of course they don't earn as much as people in the tech sector or as in the banking sector, right? So ECI is the most accurate measure, and is still showing that it's pretty high, and that's actually also showing that. And this is also not a sign of recession at all. So that's just my two cents here.
Yeah. Good comments, Jiro. Appreciate it. Appreciate everyone. Jiro, Monative, Common Sense Psych, Steve, Ted, everyone who was a speaker earlier, guys. Thank you very much. Just to kind of recap you, we do these calls Fridays at the close, 4 o'clock. We kick them off. We usually run about 2 hours. We're at the 2-hour mark. So we have some really exciting changes coming soon. I can't yet give all the detail, but within the next few weeks, we're going to be revamping some things around here, and we are very excited for what's to come, and we hope that you'll stick around, and we suspect that we'll perhaps have some larger audiences, and we're also going to add some incremental programming. So as I mentioned at the onset, and obviously I just mentioned we do this on Fridays, we also do Wednesday night open mic calls. I've been hosting them on my personal account at Rod Alsman, which I have in the audience. For now, I'm going to continue to until we complete this this thing that I'm referring to that I'm not going to go in detail on. We also have the next book club. We do the last Tuesday of every month. You can find the book club information in both the Wook server, wook.gg, if you want to join our Discord server and find that information. Of course, the Twitter handle that I'm hosting the call from as well has that information. So a lot of interesting stuff coming in very short order. We're looking forward to hearing feedback as we roll these things out. And yeah, look, just to kind of get back to the essence, we're a family office that our thesis is that we can achieve investment alpha through crowdsourcing research and doing that in a scaled manner. And it's going to take us time to prove or disprove that thesis. And we haven't been around for very long, but we absolutely look forward to, as Common Sense noted, hopefully more balanced discussions where we welcome different viewpoints, but try to keep the histrionics out of things. And yeah, we'll have more single security analysis as well coming soon. We're very excited to be putting the finishing touches on what I think will be a very exciting report coming in the next few weeks. So with all that said, thank you again, everyone, for tuning in. Please be sure to give the account a follow, and we look forward to catching up with everyone next week, whether Wednesday or Friday. Hope everyone has a good rest of their weekend out there, or not rest of, good kickoff to your weekend. And hopefully you're not holding First Republic Bank common stock, because otherwise you might not be having a good weekend. All right, cheers, everyone. Have a great one.